Welcome, everyone. Thank you for joining us for today's OUP webinar, this time focused on university venture funds. I'm Kirsten Loita of Osage University Partners, and I head our efforts here at OUP. We'll go to the next slide, because today I'm joined by three amazing panelists and friends who I would like to have them introduce themselves. I'll start off with Case.
Hi, I'm Case Cortese, Director for Innovation, New Ventures and Entrepreneurship here at Caltech in the Office of Technology Transfer and Corporate Partnerships. I've been in the office for 18 years now on the licensing team, really, but we'll kind of talk about the roles in a bit. And my background is molecular biology and virology.
Thanks, Case. And we'll go to you next.
Hi, folks. I'm Bryn Rees. I'm with the University of Colorado Boulder. Thanks so much for coming today, and thank you to OUP for hosting us.
Thanks, Bryn. Mike?
Hi, everyone. Mike Psarouthakis, Executive Director of Impact Investments and Strategic Alliances at Innovation Partnerships at the University of Michigan. We are the tech transfer office for the entire university and oversee the Accelerate Blue Fund and the Michigan University Innovation Capital Fund, which I'll talk about later today.
Thanks so much, Mike. And great to have all of you here with us today. We'll dive into the main subject really soon, but we'll go to the next slide right now because we just want to go through a few logistics. A recording of this webinar will be available via OUP's partner portal, and a recording will also be available via our YouTube channel. All the registrants will receive a link to these recordings as well as the decks that they're being presented today. The partner portal that I mentioned is an online portal for the tech transfer officers and researchers at our partner universities, and it's full of relevant tech transfer and startup content. Once you're in the portal, which you do need to register for if you have not already, you'll find a downloadable presentation deck and video link for this webinar on the webinars page. And you can also access these resources via the QR codes that Katie has conveniently this deck. We do encourage questions throughout the webinar today. Please use the Q&A tool in the Zoom to submit your questions instead of the chat function. That's a much easier way for me to be able to track all the questions. We did receive a lot of questions beforehand. I think most of these will be answered during the presentations themselves, but I've also had some queued up for after the presentations. And then I did want to mention that we do have upcoming webinars as well. We have our annual be on March 27th. Information will be coming up about that soon. And then we're currently working on a webinar that is focused on founding a startup company as a graduate student. So keep an eye out for that as well. So we'll go to the next slide because we do want to give a short intro on OUP. For those of you who do not know us, we're a venture capital fund that partners with academic institutions to invest in their startups, typically by exercising participation rights that are available through their licenses. For those of you who don't know what participation rights are, they're the ability to invest in a future round of a company on the same terms and conditions as other investors. If you don't have participation rights language that you know of, we do have recommended language that we're happy to send out to you as well. As part of the partnership that we have with our institutions, the institutions share in our profits and receive programmatic support on tech transfer and academic startups. We're now on our fourth fund at OUP, and we've been investments in over 150 different companies in all areas of finances. And if we go to the next slide, it just shows a smattering of our portfolio companies and kind of the breadth of areas that we invest in. We're always happy to talk about our model, so feel free to reach out to us if you have any questions. We'll go on to the next slide because this is our agenda for the day, and that's the reason you're here. This is what you want to hear about. First, Bryn is going to cover a landscape analysis he did on university venture funds, followed by a short introduction of their Buff Gold Ventures fund at CU Boulder. Then Case will give an overview, history, etc., on the Caltech Seed Fund. And then finally, Mike will talk about the Accelerate Blue Fund at University of Michigan and some other initiatives associated with this that have been happening in the state of Michigan. So, and then we will have time for questions. So this is one of our longer webinars. We do have an hour and 15 minutes scheduled for this. So please do bring in your questions. We'll be answering them along the way. But with that, I'm going to pass the baton to Bryn, and Bryn is going to share his happens.
Thank you, Kirsten. Get this in slideshow format and we'll get started. As that is happening on my screen, I wanted to give you a sense of what I'll be talking about. And I'm going to focus on our journey and where we started in that towards a venture capital fund at the University of Colorado Boulder was doing a landscape analysis, as Kirsten was mentioning. So this is where we wanted to see what other universities had been doing. Buff Gold Ventures was launched in 2020, but we really started exploring this concept in 2017, seriously. So the process here was to look at the time, 23 different university-associated venture funds. And we were very specific about what we meant by that. And these venture funds had to invest primarily in spin-out companies from the university's labs, so tech transfer style companies. In some cases, they could invest in other things as well, but that had to be the dominant form of investment. We noticed that there were many types of categories, but two of the gross categories are venture funds that are returns based, so more of a traditional venture capital fund, and then what we'll call a philanthropic fund, where the source of funding comes from donors rather than from investors. Now, we didn't get every single venture fund that existed. This study was conducted in around 2021. We've updated it a little bit. We haven't captured every single university venture fund. So some of the exclusion criteria, very quickly became apparent that there are many types of university-associated fund that fall outside of these core criteria. Student-run venture funds, endowment funds that can really invest in anything, and translational research funds, so gap funds or proof of concept funds, those were all out of scope here. So we're really focused on that venture or venture philanthropy approach. We also didn't include large venture funds that looked at networks or entire groups of national universities like OUP. So those 23 funds fell into 15 at public universities and 6 at private universities. So there were 21 universities in total that we looked at. So obviously there was a couple that had multiple venture funds. And back to that split between returns-based funding sources, so folks looking for a return versus philanthropic donations, heavily weighted towards the ROI-based funds. We then had a look at the size. So as you can see here, there was a very significant range in size, all the way from $1 million at the small end up to 850 million. I can tell you that the distribution across that was very much biased towards the left and the smaller end. That's really just that one large outlier at the time, which was the Oxford University Venture Fund. So the median, the most common fund size is 23 million, and an average, again, skewed by some of those larger funds on the high tail, was 77 million. And then we also asked the question of how large are the universities? Not the funds now, but how large are the universities, using research expenditures as a proxy for the size of the school. Again, large range, but we did tend to see this general trend that these are larger universities that had the venture funds, median research expenditures of 700 million and an average of a little over 800 million. You might ask, do these two things correlate? Do larger universities have larger fund sizes? Yes, there was a modest correlation there, and you might expect that, right? We could extrapolate why that might be. Larger universities may, in some cases, have a larger deal flow, more startups, more investment opportunities, or perhaps more connections and networks to raise larger funds. But there certainly are interesting departures from that trend. Okay, so where do the funds come from? This was one of the advanced questions that we got. Again, looking at two broad categories, we found that roughly 50-50, maybe a little bit less than half, came from both university providing funds for the venture fund and also outside investors, whereas a little bit more than half had either one of those two. So the majority of funds were solely sourced from the university or solely sourced from outside investors. Now, so 3 different fund types coming out of that, and some interesting things when we look at, does that have an impact or a correlation with the size of the fund? And the answer there is quite strongly yes. So for reasons that we'll get into in a little bit here, what we found was that the funds that had either all of their funding either from the university or from outside investors tended to be smaller. So you can see there an $11 million median, a $23 million average, whereas the funds that had both types of investor in that one single fund tended to be a little bit more than double the median and significantly more on the average. So $40 million median, $158 million average. So let's break this down and think about why might somebody structure these funds differently? Why might you do a philanthropic fund? Why might you have look for investors? Why might you have a combination of different funding sources as well? And how will you make those decisions? There's so many ways. That was, the main outcome of looking at these 23 funds is they're pretty much all different. I don't think I could look at any 2 funds and say, yeah, those 2 are the same. They're structured differently. And so if there's any key takeaway here, that we'll come to is, how can we start to think about how the structure of the fund relates to the strategy? So let's dive into that a little bit, look at some of these variables on the left side of the screen and how do they impact some of the outcomes on the right, namely, what level of control does the university have over the fund? What level of risk does that fund take? And how available is capital going to be in raising that fund? So let's first think about if the sole source of capital is the university. We're going to have that high control for the university, right? We don't have outside funders to have to think about their interests, possibly deviating from the universities. Now, the risk is going to be higher as well, and the capital availability in that case is much lower. We're just looking at internal funding, possibly philanthropic, if we want to bring in some external. And then the risk is going to be higher because we don't have that validation, right, from the outside sources of capital, somebody besides the university saying, that's an investment fund that I think is worth putting some money behind. When we shift to outside investors, there's going to be a loss of control, right? With that capital comes some degree of control to the outside investors, but we are risk decreasing. We're decreasing the risk, and we're opening up new sources of capital, so increasing the availability. As we saw in the data, when you have both sources, we're going to shift that capital availability up. We saw those funds were much larger. It's not just that we're saying, yes, there's so much more capital available outside the university. Is that capital available? One of the first questions that prospective investors in our fund would ask is the university invested in this, and how much? How much skin in the game? How committed is the university to this fund? And that was one of the key requirements for many investors to get on board. Okay, decision making. We saw many funds where it was an internal university committee making those decisions. Again, high level of control. We can look at many different types of outcomes. If the university wants this to be returns based, if they want this to be impact investing, if they want this to be service to the faculty, all of those things are on the table. Again, when we're making our own decisions and we don't have that outside validation, we're really increasing the risk. Some outside investors are very clear, or donors, they don't want to see purely university decisions on investments. They're worried about political influence and internal relationships at the university, as opposed to a professional risk and return based decision. Outside, having a general partner outside and separate from the university, again, we're giving up that control, de-risking slightly and opening up new sources of capital. And then the last I'll mention, because we heard some of this from folks in the community, in the investment community, what about rules-based investing? So we're attempting to take some of the subjectivity out of investment decisions, having a set of criteria, and then deferring to those. There are some funds like Endeavor Capital that were set up that way. And what we found when we floated this with prospective donors, prospective investors, when we still didn't know what kind of a fund we were going to have, we got strong feedback that this was not popular. Okay, I have three main take homes for this presentation, and here's the first one. The strategy of the venture capital fund should come first, and that should drive the structure. So I've just introduced all these different variables around size, how decisions are made, how the fund is structured inside or outside the university. And if one starts making those decisions with structure first, I think we should have a $100 million venture fund because university so-and-so did that. I think we should have a fund that sits outside the university because that seems to be legally easier at my school. That's going to dictate your strategy. And so before you know it, that investment fund has a strategy that perhaps wasn't consciously or intentionally put together. So I think the first thing any university should do is think about why they want the fund. What's the purpose of that fund? Is it financial returns or is it not? Because I think there's many instances where universities are looking at venture funds where returns are important, but they're not the primary objective. And in that case, the structure could look very different. Okay, I'm going to dive straight into the second take-home message, which is what needs to be in place before a venture fund is put together. We've had a lot of inquiries since launching our fund at the University of Colorado Boulder, which is called the Buff Venture Fund, and a lot of inquiries, especially from universities outside of the US who are looking at doing a fund. And in some cases, they're looking at that fund to catalyze and create a startup ecosystem. And I think one of the real considerations here is that could be backwards. Starting with a venture fund first could be severely lacking the type of ecosystem support structures that are going to make that fund successful. So here I'm depicting it as a hierarchy of needs, with a venture fund being the pinnacle or the last resource to come online. So we start with a foundation of intellectual property management and licensing functions, or your core tech transfer capacity, having policies at the university or perhaps the research organization that address what happens when somebody wants to found a company. Can they do that? What are the practices around conflicts of interest and conflict of commitment, their ability to hold equity, their ability to allocate time to their venture, their ability to possibly take sabbaticals? That all needs to be clear and fairly seamless. Educating folks who are trained as academics about how they can be successful as founders is critical. The university doesn't necessarily have to create that themselves. There's a lot of great resources out there, but having those available to the community is important. Having seasoned mentors who've been around the startup world, who've had their own companies, that's a critical element as well. I mentioned at the start, we did not look at gap and proof of concept funds, but in our analysis, but of course, those are critical. Most venture funds would love to see non-dilutive capital supporting those companies before they're ready for a private investment. A startup accelerator that can go alongside the fund is not only good for helping those founders make quick progress as they launch their companies, but it's a great source of diligence. So if the fund has access to founders as they move through an accelerator, that's a tried and true model for many investment funds. And then lastly, is there an analysis that says we have a deal flow, we have the companies in terms of volume, and also the companies that are validated through raising outside capital? Do we have evidence of that to support a venture fund and a venture fund of a particular size? So I start with this again, where folks are saying we'd like to do a venture fund, and I really encourage them to ask all of these questions. Do we have the supporting conditions that are going to support a venture fund? So what does that look like? A retrospective assessment of deal flow is how we approached it. So we pretended that we had already had a fund for 5 years, made up some assumptions about when we would and would not have invested, and then did an analysis. So this was looking at the period of about, I think, 2015 to 2020-ish. I think it might have been more closer to 3 than 5 years. And we looked at our companies in our portfolio spinning out of the university that would be eligible for an investment from a university-affiliated venture fund, and said, what would the portfolio look like today, right? And we came up with this mocked portfolio. And some of the outcomes or some of the questions that we asked is, where would the fund have invested? How much would we have invested? And is this a portfolio that we could not only feel confident about ourselves, but that we could use this as a tool to raise the fund? And that's exactly what we did. So we had what would have been some excellent outcomes in terms of increases in valuations and exits that were really, we could show as, hey, these were missed opportunities that had a fund been in place, you as an investor or you as the university, we could have been having shared success here. Now, I've talked about saying the portfolio looked good. What does that really mean? How did we assess the performance of a fund? And how will we and how are we assessing the performance of our current very real, not mock-up fund? And there's two types of measurement that are quite common that we've been implementing. The first is MOIC, or multiple on invested capital. And this is a very simple formula where we're just saying, what is the portfolio of equity held today? What is that valued at versus what did we pay for it? Right. So what's the, we should have something over 1 if we're successful. And if our investment values have gone down, it's going to be something less than 1. The second type is very similar to MOIC, or multiple on invested capital, but also takes into the takes into account the costs of running the fund. So it's a slightly more realistic and slightly more accurate measurement of performance. And that's TVPI, or total value paid in. So this, again, is simply what is the portfolio worth today as a function of not only what did we pay for that those equity positions, but what have we paid in terms of the costs of running the venture fund as well. So in both cases, or rather in the case of TVPI, which is more commonly used, the value initially goes below 1 because there are costs of running the fund. We make these investments and it takes time for the valuations to increase. It's not going to be until a subsequent valuation that we know that there's been an increase or an exit event. Both of these, MOIC and TVPI, are looking at the unrealized valuation of the portfolio. So it doesn't necessarily mean that there's been an exit and cash returned to the fund or to the investors. Instead, we're just looking at the unrealized gains. So an increase in valuation, but it's not necessarily liquid, right? We don't actually have the ability in all cases to sell those increased valued shares. Okay, so what did we do here at CU Boulder after this analysis? We formed Buff Gold Ventures. This is a $25 million seed and Series A venture fund. It will invest in, or it is the companies that are eligible to pitch, or any company with at least one co-founder who's faculty, student, staff, alum at the university, or if we have outside founders that are licensing IP from the university. This sits outside the university doesn't manage, operate, or control the fund. So this is a Delaware limited partnership, which is the most common legal structure for a venture capital fund. We have 30 different limited partners. The limited partners are the investors in the fund. The general partner is the fund itself, so Buff Gold Ventures. And the university is one of those LPs. The seed stage investments are $200 to $400K, and it's $1 million up to about $3 million in Series A investments. There's been 10 different companies in the portfolio across 16 investments. So there's been multiple investments in some of those companies. And about almost a third of the fund has been allocated in the 3 years since the fund has launched. And looking at that MOIC, or multiple on invested capital, it's a little bit over 1. So some of the companies have increased in their valuation. This is the last slide. So what I want to introduce, this is the third take-home message. And going beyond the idea that a fund is going to be one size fits all solution for all your capital needs, I think that's something we certainly have confirmed is not the case, right? And so we're now thinking about the total venture capital stack available at the university rather than just the one fund. So as we move from left to right here, from early stage to later stage funding, universities tend to take on more of the risk at those earlier stages. And then in the later stages, we're looking at funding outside the university to pick up the majority of capital. So this kind of double wedge depiction is something that we looked at in our own ecosystem. Buff Gold Ventures, again, is seed and Series A, but when you look at the spectrum here, look at all the white space, right? There's so much more needed in the capital stack. We do have some proof of concept and gap funding capabilities. We had some very modest, in the hundreds of thousands of pre-seed investment resources and an event to bring in outside investors for later stage. But we had this big gap in the pre-seed level. So once we realized Buff Gold was having good traction in the seed and Series A stage, we had this real need for pre-seed capital. And so we created a new pre-seed venture capital fund run within the university, very different structure and different purpose than the seed and Series A fund, to kind of round out this capital stack. So that's, again, the third and final take-home message. One fund is not going to be all things to all people, and we should think about how that fund sits in the total opportunity of funds at a university. Thanks so much.
Thanks so much, Bryn. I'm going to ask you 3 questions while Case pulls up her slides. So if you can stop sharing, then Case can pull hers up. And I apologize if my audio skips. I'm having a little bit of audio difficulty. But my 3 questions. First is, for the 23 funds that you looked at, you mentioned Oxford. Are there any other outside of U.S. funds, or were the other all U.S. based?
They were all U.S. based. It was just Oxford.
It's just Oxford. Okay, great. When you talked about the funding sources, could you provide some examples of the outside funding sources that the venture funds had?
Yes. So in some cases, it could be alumni, private individual investors. We did not see that in our own fund, but in other funds, that's quite common. And then there are funds of funds, so funds that invest in other venture capital funds. That's another common one. For us and for many others, the most popular source of funds was private individuals who have some kind of affinity either for deep technology, these types of investments, the local region, so business development in wherever you are, or for the university itself.
Okay, great. And then last question, do you have a sense of what percentage focus the investments their own spinouts versus spreading capital outside of your their own institution? Or were all of these focused on their own spinouts? And then from there, were they focused on spinouts that were associated with their tech transfer offices versus otherwise in the university?
Yeah, so in the assessment, that had to be the majority of investment funds. At our own investment fund, I can tell you it's essentially all lab spinouts, tech transfer, IP-based companies. There's a couple deep tech companies formed by university community members, alumni after they left the university, but they're definitely in the minority.
Terrific. Great. We have a lot more questions, but we want to get to our next presentations. We will be answering the rest of these questions later. Thanks so much, Bryn, and on to Case.
All right, so let's talk about the Caltech Seed Fund. A little bit about the history. So like Bryn, we had been talking about it for quite a few years before we actually launched. We launched it in 2021, really, but had been doing talking to local investors and folks that were interested in supporting our startups. For a few years before that, we did a similar type of analysis on, do we have the deal flow? Do we have support for this? A little more qualitative than his quantitative, but nonetheless, a similar analysis. Sorry, this is an advance. Oh, there we go. Okay, so let's jump right into why we want to do it in the first place. As we all know, the Technology Transfer Office is trying to launch these startups, and there are a lot of support a lot of different kinds of support that these startups need. The main buckets that we put them in are human capital, like management, and supporting the students and inventors that might want to spin out with the startup, early stage funding, and then specialized facilities. So really today we're talking about the one in the middle. So the elements that we want of the innovation ecosystem we really wanted to support were, and the purpose of why we wanted to sort of add this fund to all the pyramid that Bryn had talked about, that our tech transfer office already had in a pretty mature way, was to add the funding to the top. And so these are the actual part of the charter of the fund, these bullet points, to illustrate the purpose. So we really want to strengthen the entrepreneurial ecosystem that was around our campus, either the greater LA area or even better, actually in Pasadena. Increase the number of Caltech technologies commercialized, to reinforce Caltech's competitiveness of recruitment of faculty and staff. And students. We are seeing an increased interest, certainly from a lot of faculty and students in entrepreneurial activities. Create learning opportunities for students. I'm not really going to focus on that today, but we have a internship program that launched in parallel with this due to some philanthropic support from folks that heard about the fund and were interested in supporting the university's entrepreneurship further. And then, of course, the 2 bites of the apple, increasing philanthropy from successful entrepreneurs that may want to give back to the university in the future. And last, and it's last on purpose, is provide financial returns to Caltech. So I will echo what Bryn said as far as if you want to launch a fund, it is key to know why you're doing it, who cares what you're doing, and who you may need to answer to at the end of the day. Do you need to show returns or not? And that all can stem from where is the money coming from, who's controlling it, and is there a return expected, that kind of thing. So let's talk about the overview of where we landed on ours. I won't spend a lot of time on why, though I can during the Q&A if people are interested. But we started a fund that is focused solely on, or primarily on, startups based on Caltech or JPL technologies. So that would usually be a licensee. We will consider other fits. We did allow for that in our charter, but we expect it to be mostly licensees out of the tech transfer office. We will only do pre-seed or seed investments, meaning first money in, because those terms can be sometimes ambiguous, but our focus was first money in, and we won't do any follow-on investments. The Caltech Seed Fund has 10 million approximately committed over 5 years, though that does include some support that we need to use for the EIR program. I'll talk about that in a minute. The source of funding is internal Caltech funding, and this is key, and this we'll talk about quite a bit in the next slide, which is we ended up partnering with a co-investment fund that is external to the university. Our seed fund is covered by 3 committees. We'll talk about the decision making of how the mechanics of how we run decisions. But basically, there's an internal daily management decision making committee we call the Fund Executive Committee. There's an external diligence review committee called the Fund Investment Advisory Committee, or the FIAC. And then there is a trustee oversight committee. They do management oversight, but they have a much more minor role at this point now that we've launched it. Any returns from the seed fund will go directly to Caltech. Okay, so as I said, we actually landed on a 2-fund structure because as we were exploring the different ways, and like Bryn, we agreed we came across a wide variety out there. We did a benchmarking. There's a wide variety of different kinds of funds and there is a mix then of who controls the money, what's the source of the money, and then where do the returns go. So we had a number of people external to the university, high net worth individuals and friends of Caltech, I'll call them, alumni, people interested in, they had repeatedly come to us and said, how do we invest in Caltech startups? We want to do more to invest directly in Caltech startups. So we really wanted to capitalize on being able to deploy that capital to help our startups, but we did not want to lose the control that Bryn mentioned. So we really wanted to run it outside of the tech transfer office, and we knew that this was going to be a small-ish experiment in the beginning, as opposed to, example, the engine at MIT that launched with a really pretty big fund, but had management outside the tech transfer office. So we basically could not come up with a way from a conflict standpoint to actually take LP money into a nonprofit, which is what a university is, and control it through the tech transfer office, but uphold the financial diligence that you need to be a traditional GP-LP structure. So we split it into 2, and we split the baby. We have the best of both worlds, we think. So we use some Caltech money, again, 10 million within Caltech, comes from the general budget, not from the investment office, if that matters to some folks, which, okay. And then a second fund was launched at the same time, and we called it the Wilson Hill Fund. Now, we essentially did the fundraising together. It was really one fundraising push, but we then launched what we called the Wilson Hill Fund. It is essentially a co-investing shared carry fund. It's a traditional venture-backed GP-LP structures, and it raised 31 million. And we have a contract between the two. So Caltech has a contract with Wilson Hill that, in exchange for seeing all of our deal flow and working with the fund, this Caltech Seed Fund Executive Committee, they will share some management fee, half the carried interest, and they have a co-investment obligation. So they have to meet or exceed all of our investments. 1-to-1 at least. There is a little caveat there as we were putting together the PPMs for the LPs in Wilson Hill, it couldn't be quite that 1-to-1 because, again, as Bryn mentioned, we had LPs that were concerned properly that they wanted to be able to control truly what investments were being made. So if the university, for example, makes a decision that we really want to invest in something that the Wilson Hill Fund truly disagrees is going to be a good return on investment, they basically have an out. So we have some language in there that they do have some out, but the spirit is that they need to invest with us 1-to-1. So let's just go through briefly who the actual people are not as important as just to give an overview of how decisions are made and who's involved. These fund executive committee that's running the day-to-day, these are, so the director of the office, Fred Farina, myself, and the two entrepreneurs in residence, Mary Beth Campbell and Julie Schoenfeld. These are university employees. They sit inside the tech transfer office. We have weekly meetings with the licensing team. So they are directly involved in the intellectual property and the inventions and disclosures and everything coming out of the lab. We have another set of folks who are inside Wilson Hill. So Michael Boris, who had been the founding GP of XE Capital, John Fiber had been at Moore David, he's more advisory here, and then Jay Chang and Jay Shria are operating partners within Wilson Hill. Those of you who may know Caltech know that Jay just left as EIR at Caltech and has moved over to Wilson Hill and has taken over also as CEO of one of our startups. Jay is also CEO of one of our startups while also being an operating partner. So these are two spin-offs that came out of Caltech just within the past year. And Jay took such direct roles in leading those. They are actually the CEO right now. And then the external advisory committee is made up of folks at local investment funds. And then Dave Licata is the only one not an investor right now, but he was an EIR at Caltech and has done previous Caltech startups. Exited one and then took out 1200 Pharma and Toro Biotherapeutics, which is a UCLA startup. So a lot of experience there. Okay, decision-making process, just this is a complicated slide, but basically it's just a multi-step process where the monitoring of the investment pipeline at Caltech starts with the invention disclosures and the licensing team. The EIRs again are embedded with us. And we have weekly meetings. The EIRs then, for those startups that have interest in the faculty, the student, the postdoc is interested in actually launching something, they will start mentoring that project. There will be an internal pitch to the executive committee, the EIRs, usually the licensing team, probably Wilson Hill at that point, to see if there's increased interest in investing, if it looks good, if the development of the technology and the deck and everything, the EIRs will help them do customer discovery, that sort of things. We advance them to actually pitching to the external FIAC. They will then, and only that subset of those that we're really pretty sure we're going to invest in will go in front of the actual FIAC. There's sort of an iterative discussion of then what is the funding needs for that startup going to be, safe versus equity, who's going to lead the term sheet. I'll talk a little bit more about that. We do, if the seed fund does kind of takes the lead, we only do safes. We do not price. We don't have the experience to price, we don't think. But let's talk about how the mechanism of how we invest in a second. But then we'll make a final decision and then execute the financing docs with the startup. Okay. The investment risks, these are all very standard and what we evaluate under for market, technical risk, intellectual property, what's the intellectual property landscape there, who's the team involved, are there regulatory considerations, competition, differentiation of the technology. And then we layer on top, do the investment opportunities fit against our fund goals? So is it going to stay local in the LA area? Is it commercializing Caltech IP? Are there students that are leaving to go with the startup? Is there, and then the potential for financial returns, of course, does get considered. We have looked at 104 investments in our kind of deal flow. This was since 2021, really. We funded 25, 2 are pending, 8 are actively under review. Main reasons for passing would be we need to see particular milestones. We're still working with the EIRs on what is the market potential there. Maybe it's out of scope for what the small investments that we're doing. I'll talk about that in a second. If they're not commercializing Caltech IP, it's maybe not really a good fit. Anyway, when we decline, we do give very specific feedback. We have not found declining to be a real big problem. It is more common that there is something about the startup that's really out of scope with the seed fund. So we haven't had really any political problems with turning any potential investment down. So our activity, of the 10 million allocated for about 5 years, we've deployed about 6 million, 25 investments. So we've got about 2.4 remaining, because again, some of that 10 million is going to supporting the EIR program. The seed fund is doing mean check sizes of 250K, but we've done anywhere from 100, 500K. Wilson Hill, I will note, is doing more. As you can see, their mean check size is 850, larger range as well. And I will also point out that this is just at launch, and Wilson Hill can and does do follow-on investing because, again, they're more traditional structure, so they have reserved capital for follow-on investing. So the actual dollars deployed by Wilson Hill is much larger. Excuse me. Okay, really quickly, here's of the 25 investments, here's what we're seeing. The technology sector is pretty spread out, about half in life science, some sustainability, some physical sciences, kind of split evenly. Investment type is half safe and equity. We can talk more about that. Maybe I'll say that for the Q&A if people have questions. But essentially, we will do a safe unless somebody else, investors, institutional investors come in at the time of investing and they want to do a priced round, then we will still participate, but we will follow the term sheet as an institutional investor has given that startup. So we're a little agnostic on that. A lot of female founder involvement. We are trying to track that because we're very supportive of that, of course. So we're seeing a good number of female founders involved, someone on the founding team. Outlook, we have, it's still early, so hard to say. We have had one exit, very odd situation, but it went straight from a safe to an acquisition. I won't go into a lot of details on that now. I can talk about it if people like, but basically that was an unusual situation. It wasn't a big home run, but we made our money back, so that was good. It wasn't a loss. So most are still chugging along pretty well, and we really only have one that we think that's gone into hibernation mode. So we think that's probably not going to make it. And then the location, most of them are staying in the local ecosystem. So this is, again, getting back to the metrics of what we see as a measure of success would be, do they get another round of funding? Which is the purpose of our fund, is really to set them up to get institutional investors in a larger A round, and then do they stay local? Okay, these are just some numbers of what we're seeing. So at the seed raise, the average is 4.6 million, but the range that we see at launch is anywhere from 600 to 16 million raised. Valuations, that's probably not as important right now, so I'll skip over that. Again, we've had one acquisition, 8 valuation step-ups, 4 of the safes have converted already, and then the valuation, to the extent that I know how to do that right now, is I'm not trained in this, so I'm learning on the fly, but it is larger. Again, with the valuation step-ups, we have the valuations are larger than what we've put in, so that's good. I'm gonna skip the objectives, they're not as important here, because I think that there are some comments in the lessons learned that are sort of discussion points to think about. That we have definitely found that Caltech's interest, our seed fund interest in our startups has absolutely attracted other investors to the funding at launch. And that's why so many of these have turned into equity rounds. We didn't actually expect that in the beginning. We assumed we would be the only ones in, we in Wilson Hill, as a safe round to tee up the company to have a year or two of runway to attract maybe a seasoned entrepreneur or someone that has some experience into the company. That's very hard to do when you have no money in the company, right? This is the chicken and the egg problem that startups have in the beginning with no funding. That is not actually how it's playing out. So many institutional investors are getting interested in the pitching and just sort of the soft circling that the EIRs are doing, that they are stepping in and doing a price round. It can still be hard to decide when is too early to do to actually launch, but that's always the challenge with our startups. The educational component, I will say, the intern program, again, not the subject of today's talk, but it has turned out to be quite valuable. It got attention from alumni who heard about the seed fund and wanted to help. And we do now a summer program with interns, Caltech students, and we match them with startups that maybe need to do some market analysis or some customer discovery. So it's literally matching with the deal flow that the EIRs are doing as they're trying to launch the companies, and it really adds value to the companies. And we've even gotten some of the students have been kept by those startups as they've launched. The EIR program, these two full-time on-staff EIRs are key to all of this. And really hands-on, almost an acting CEO at this really early stage, really hands-on in getting these companies launched. And then the lack of follow-ons for returns, lack of follow-ons is going to restrict the ability for us in the seed fund, not necessarily Wilson Hill, but the seed fund, to actually show returns to the university. This gets back to, does it matter? So for the charter for the Caltech Seed Fund, probably not, but like all tech transfer offices, even if they say returns from licensing are not the reason for doing the licensing, they always ask you at the end of the year, how much licensing income did you make? So people still care and they still want to know if you made money. Okay. And then talent, this is the never-ending challenge. Talent is still a gating factor for the early stage management of these companies. Even with the EIRs, it's still the biggest hurdle that we are trying to match up seasoned entrepreneurs with experience who have the technology experience, who time-wise are available to maybe do their next startup, and match personality-wise with the faculty member, because the faculty are always very still involved in their startups. So that that matchmaking still is a pretty big challenge. And with that, I will stop sharing.
That's fantastic, Case. So Mike, as you pull up your slides, Case, I'm going to ask one question to you.
Yep.
Mike's presentation, and then we have, like I said, a lot of questions. So for the gains from your investments, where are those gains going? Back to the university, back into the fund, back to the TTO? Where are they headed to?
Yeah, that's a good question. Ostensibly, they're going back. So they're not going back to the TTO. They are not technically going back into the fund. They're really going back to the general budget. Having said that, this is at Caltech, we like to say we build the plane as we fly. So it certainly will get us goodwill when we want to do the next round. We are in talks of that right now. Wilson Hill 2 has already fundraised and done a first close. The seed fund, we will probably have to do philanthropically based, but it will get us goodwill within the university to free up some more money back out of the general budget for that. But right now, the answer is just goes back to the university.
Great. Thanks.
Are you seeing that?
Yes, you were,
Okay.
yeah, and you just do slideshow and you'll be good.
Yep. Okay. It's just acting a little funny on my screen. All
Okay.
right. Hi, everyone. So the agenda showed that I was gonna talk about the Accelerate Blue Fund, but we've had a lot of things happen since I did Autumn West on a similar presentation. So gonna bring some other topics to the conversation. We're a little behind time. So I'm not going to repeat what a lot of things that Case and Bryn have gone over because they're very similar. But a common question we get is, why does Innovation Partners have to manage 2 venture funds? And one of the reasons is we have incredible deal flow out of the University of Michigan, as well as our partner public universities in the state. In fact, we support the launch of about 1 startup every 3 weeks. You can see, and we're trending up. So anticipate we'll launch close to 30 startups this year, and similar number last year, and see that trend continuing. But we deal with a challenge, especially in the Midwest. Startups typically take 2 years longer to raise their initial pre-seed seed funding in the $500,000 to $1 million range. And that's problematic compared to startups in the other parts of the country because they just fall behind. And even more so, and focused on U of M startups, our startups are really successful in raising capital in the later stages, and in fact raise billions of dollars over brief time periods. But if you look at this data here, and I won't go through all the details, the talking point in the bottom left corner there is really the key. 96% of the investment capital that goes into U of M startups comes from out of state, yet half our startups are in Michigan, and as a result, they struggle. So these are just 2 prime examples of companies that left Michigan for very small amounts of capital, took resources away and had to spend resources in relocating, and missed opportunities for the university ecosystem and the entrepreneurial ecosystem in Michigan to benefit from the success of these companies. Mythic left for a fund $500K investment to go to Austin. Was a better talent base there for what they were doing. Neurable literally left for a $400,000 investment, took a team of 8 because they could not raise the capital here over 6 months, and then within 2 weeks raised it there on the condition that they moved to Cambridge. So Michigan, again, is also rich with resources. We have a tremendous talent base inside the office, the ventures team, the investments team, the licensing team, our corporate alliances team, more so than many universities have. And these teams, in essence, support the activity we do within the office with translational gap funding, mentorship, connections to entrepreneurial talent, and of course, connections to investors, and now an investment fund. So this is a slide we use to advocate within the university to get the fund off the ground. We thought it would be a force multiplier. We're now getting over 600 invention disclosures a year. Again, mentioned 20 to 30 startups. This all resulting from what is now over $2 billion in research enterprise out of the university. And so we anticipated that we'd be able to leverage all of this activity to support raising a fund. So what does that mean, raising a fund? For us, we proposed within the university to raise a fund through philanthropy. The university did support the team, but did not put actual investment dollars into the fund until just recently. And so our regents, we're a public university, the regents of the University of Michigan approved fundraising for the fund in October of 2019. And then we started. Kelly Sexton, our associate vice president, and I started meeting with donors, working with our development team. And we were fortunate to raise our first $1 million by October of 2020. And our goal was launching the fund once we had $2 million in commitment, which happened in April of 2021. As you can imagine, much of this happened over Zoom because of the pandemic. And we made our first investment in April of 21 in a company called Movelis. We continued to fundraise because $2 million wasn't going to be enough for what we anticipated would be the deal flow. And today we're at 15.8 million. We've deployed about 7.2, and in 28 portfolio companies. And then you'll notice on the far right of this timeline, MUICF, and that is the Michigan University Innovation Capital Fund, which we launched based on the Accelerate Blue model, but it supports startups that have a license of technology from any public university in the state and must be substantially operating in the state of Michigan. And this was funded by the state of Michigan's Michigan Economic Development Corporation. I'll go into more of that in a few. So this is the announcements about launching MUICF, which is what I'm going to call that from now on. It's again focused on startups that have licensed technology through the tech transfer office at any public university. We have a consortium of university partners that you can see at the bottom of this page. So we're making sure we have access to all the deal flow. And we have made investments in non-University of Michigan startups, which was not something we really anticipated would be happening, but happened because of the success we had over the 3 years, excuse me, with Accelerate Blue. And then this advocacy also started other conversations. And so just a couple weeks ago, Kelly and I had the opportunity to go to the bill signing for something called the Michigan Innovation Fund. And this was a collaboration of pre-seed, nonprofit evergreen funds around the state that had previously received state support. Accelerate Blue up to this point had not. And a bill was signed into law that created the Michigan Innovation Fund, which will support 5 of the largest pre-seed funds in the state, including Accelerate Blue, as well as entrepreneurial activities and some emerging pre-seed funds that are just getting off the ground. This was a huge, I don't know, endorsement of what we need to do in Michigan to support our startups, and also a little bit competitive to our friends down in Ohio, who have been doing this quite actively with large sums of money over the last 5 years. And we can see the success they had, and we thought we could do the same thing. And we'd like to compete with Ohio. So right now we have, like I said, 15.8 million assets under management. That will be more than 25 million come May once the funding lands from the Michigan Innovation Fund. Our goal is to get the Accelerate Blue Fund to $50 million. And the reason we want to do that is one of the big challenges we have seen with pre-seed funds that are structured the way we are, where evergreen, all the funding goes back, is that it's a lot of stop and start. And that is not helpful to the startups that are coming out of U of M or the startups that are coming out of other universities. So we feel very strongly that we must have enough capital to basically make investments for 10 years with no returns. We'll go into more details on the size of our investments and that kind of structure. And then the Michigan Innovation Fund, we have 5 million under contract from the MEDC. We anticipate an additional 5 million every 2 years for up to 10 years. So, you know, around $20 to $25 million, but that's not guaranteed. So we'll operate MUICF as best we can, and then work with the state to get additional funding as proposed. The structure is Accelerate Blue is an evergreen fund. The majority of investment returns go back into the fund for future startups spinning out of U of M only. MUICF is evergreen for 5 years, and then there is a very friendly payback component, which I can talk about more if people have questions about that, to the MEDC for the next 10 years after that. And at the 15-year mark, if we have not paid back the 5 million or the additional capital on 15-year cycles, it's forgiven. So again, pretty friendly terms, no interest, no increase in amount of return. Anything above that 5 million, we could retain for future investments. The keys here, and I won't go through all of this since we're short on time. Accelerate Blue, the startups must have an option or license from the University of Michigan. Our first check is 100 to 250, and we can lead. We love to syndicate, but we often don't. I think 11 out of our 28 companies we've taken the lead or co-lead. If we're leading, it's a safe or convertible. We will do equity, but it has to be priced by an institutional or a venture fund. And our rules for cap in any single company is 10%, so that increases as we get more capital, and currently 1.5, in theory, could be 2.5. We have not put more than $1 million. We haven't put more than 550,000 in any single company, but that'll soon be, will be close to 900,000 in one. And this is an interesting component. As an evergreen fund, it is important to get returns so that we can continue being evergreen. So 20% of our, up to 20% of our assets under management may be invested in opportunistic deals. So later stage, we've done a Series D, for example, that we were invited into. We've done some bridges between A and B, but it's capped at 20%. Everything else is focused on pre-seed and seed. The rest of this is pretty obvious. MUICF, smaller checks, earlier high risk tolerance, 50 to 150K. Again, the rules are pretty much the same, except we can't invest more than 250 in any company, and that's by the terms of the contract with the MEDC, that we expect that to go up early. And we have a 25% opportunistic, but the company still must be in the state of Michigan, where Accelerate Blue can invest anywhere in the country. This is our process, pretty standard. I won't go through this. Due diligence, again, pretty standard. I don't think you'll see any surprises here, but happy to answer any questions for people who have that. Portfolio overview, 28 companies, 7.3 deployed, 7.3 valuation, 7.27 deployed. So we're slightly above like everybody else. We've actually had 2 write-offs and a write-down, but we've also had some nice valuation bumps. You can see the distribution of sectors as well as early stage or later stage. I also wanted to show the breadth of what we're investing in out of Accelerate Blue from the schools. It's pretty broad. You'll see more on the tech and engineering side, because initially Accelerate Blue was only focused on tech, and then once we raised enough capital, we broadened to all sectors. And I did want to talk about fundraising, including, we're getting this additional money from the state, 10 million. We've raised money from donors. We've raised money from corporations. We have operational support from the U.S. Economic Development Administration through a broad regional grant that we were part of. Interestingly, in our donor efforts, we also raised a $1.7 million bequest for a postdoc commercialization program that we already run, also supported by the Michigan Economic Development Corporation, called the Tech Transfer Talent Network. So we hope to not get that money for a while, but eventually that will land to support postdoc commercialization projects, where the grad student postdoc wants to take the technology up to a startup. We're also part of, Michigan just recently announced a $7 billion capital campaign. We were very excited that Accelerate Blue was a named focus for the Office of Vice President of Research. And as a result of this, we're having national and international engagement with alumni, family offices, foundation, and corporate. Kelly and I are doing a lot of traveling over the next few months to support that. And we continue to look for additional support from federal and state grants. Jobs created pretty higher than we expected, actually, in the 3 years we've been operating the fund. The leverage of every dollar going in, and screen's partially black, so I can't see the number, 48 now, is also dramatically higher than we anticipated. And what we have found really interesting is that 22 out of our 28 startups that have received support have an underrepresented inventor, founder, CEO, or C-level executive. We are not DEI focused in any manner, no matter whether that term is popular or not these days. It's just the reality of our ecosystem and the people who are engaging with our office in launching startups. And let's see, pretty basic standard results. It's only been a few months for MUICF, but we've deployed 1.2 million in 7 companies and 3 universities so far. And the distribution is about what we expected. 60% U of M startups because of our volume is dramatically larger than the other universities. Close to 30% for Michigan State, and Michigan Tech is in there. We've got a nice solid portfolio of projects or startups from other universities as well. So we'll see these numbers flux as over time. So here's more data on this. What I would point out here is it's really exciting to see that we've been able to use the Accelerate Blue Fund model to support spin-outs coming from the other universities, which is built on the statewide translational research programs that we have in the state, as well as a statewide university mentor in residence program. And in fact, we're trying to launch a entrepreneur in residence program, statewide university-focused entrepreneur in residence program if we get some EDA funding out of the Build to Scale RFP that was out just a little while ago. Funding support for MUICF is entirely going to be from the state of Michigan. I've already talked about this. We have a really great consortium of other university partners. Some of them have their own funds, and work very closely with us to make sure that our deal flow is up to date. And then the CDA Build to Scale program I've already talked about, which was we're going after 4.8 million for that program. We received 4.8 million in cash match from the state of Michigan because they were excited about this. And this is not a program just for Michigan. It will also support the other universities listed here. We've talked about the benefits and challenges on the slides. I think I'm going to skip most of this other than engagement with investors and government entities and partners in general has dramatically increased and I think improved since we've launched Accelerate Blue and activated investment activity. It's opened up so many doors for our office, and we're really excited to see that continue, and we're confident it will over the next few years. The challenges are, I think, pretty laid out here and not unexpected. And I think the biggest lessons, you have to be positive launching one of these, especially if it's internal to your tech transfer office. Figure out your mission and then get some partners internally and then externally to advocate for it and hopefully have successful launch. And I'll stop there since the time's running out.
Thank you so much, Mike. We do have a lot of questions from folks. I do want to mention to people, and I'm going to put this in the chat. At OUP, we have gathered up a list of university venture funds. It is not wholly encompassing of what is out there. I'm going to put the link in. This is actually a link to what is in our partner portal. If you don't have access to our partner portal, just reach out to us and we're happy to send you this list as well. And if you know that we're missing something, please let us know what should be added to this list. And this will help everyone. This is one of those resources that we're trying to help everyone with. Mike, I'm going to ask you really quickly, working with your development office, what were the hurdles that you had and how were you able to overcome them?
We're a central office like most tech transfer offices. And so we don't have alumni that graduate from anything we do. And schools justifiably are protective of those relationships. So we were fortunate to have an incredible development officer engage with us even before the fund was approved to help us figure out a strategy to engage with alumni primarily that have not actively engaged with the university to support activities. And once we had a little success there, that brought the skepticism level down. And we started opening doors. We had potential donors speak with us and go, oh, we're really excited about that, but we also want to fund scholarship at the med school, or we want to donate 2 electric vehicles to M-City, our autonomous vehicle driving testing ground. And over time, we have built a relationship, which took time. It did not happen overnight, that allowed us to become part of the capital campaign, which, to be honest, was something we couldn't have anticipated in our wildest dreams, because it was contentious at first that the Tech Transfer Office was going to go out and fundraise from donors.
Thanks, Mike. Bryn, next question I'm going to direct to you. One of the issues I think that I've heard from a number of universities in setting up these funds is that obviously you want to invest in the projects that the people who are advising you suggest to invest in, but there may be political pressure at the university to invest in other projects. Bryn, how do you handle this?
Yes. So for us, that was the legal and operational separation, right? So I can understand that certainly if you're making those decisions within the university, there could be pressure, right? Somebody could go to however high they want to go, president, chancellor, regents, whatever, trustees, and say, I wasn't chosen for an investment. And if that person holds a lot of power at the university, that's a very difficult situation. So I think that if you are somebody who has your fund inside the university, you can still leverage outside advisors to help make those decisions and kind of put it outside the university. So nobody at the university has to say, Professor so-and-so, we didn't invest in your fund. And, you're kind of in some ways talking to somebody who may have a lot of leverage at the university. Whereas, we have an outside committee comprising venture capitalists and professional investors who advised us, and you have that decision you can lean on. But for us, we totally separated it, right? So there's nobody at the university who makes those decisions. If somebody tries to, within the university, influence a decision or use the power that they hold at the university, there's really nowhere to go, right? The decisions are made by the general partners of the investment fund, and they're accountable to the limited partners to maximize their return on investment, and that's it.
Case, next question to you. How do you navigate the tension of your fund being associated with the university, or are investors happy to co-invest with the university? What has been your experience with this?
No, investors are usually happy. If anything, the signaling that we are giving by saying we will, we're willing to put 250,000 in, has so amplifies the signaling that this startup is a solid one to back. That's why we have so many of our investments turning into equity rounds, because the institutional investors actually step in, take over, and say, okay, actually, we don't need to wait a year to see how this goes. We're going to give 7 million now. We price it, and because we've done so much work and we still think it's a good investment, we'll still put in our 250K. But we're finding that the signaling more than the 250,000 is amplifying the additional investment from those other investors into the startup in a way that is actually outpacing what we expected. It's really great. So no, we have not had anyone who doesn't want us in. Maybe one, but not much.
Well, so a next question to you, Mike. Are there local partners that should be involved in the earlier stages of planning a fund? And maybe, Bryn, I'll pass this to you as well, because you did the landscape analysis. But Mike, were there local groups that were able to help you establish this fund and as recommendations for others for what they should be doing?
Yeah, so we worked, we have, and some of those members are now part of our investment advisory board, which is people separate from the university, as Bryn mentioned, that review all of our deals for both funds. No, there was a lot of internal work with some national advisory board members, as you know, who were advocating to get the fund off the ground. And we did work with the local venture community to get their feedback on, we thought about an external fund similar to what CU does. We thought about an internal fund. We thought about launching both. So the feedback from the VC community was important, but also the economic development organizations And the collaboration's actually built has grown dramatically after we launched the fund and had some success, which led to these other initiatives and the new fund that we weren't really anticipating because of those collaborations. So we're seeing actually, it was important to have it initially, but we needed to get internally approval and then get some money in the bank. And then we did get university funding and then enough deal flow. And the collaborations have been much more impactful, honestly, because of the new programs that we've been able to go after, where initially there was a core group that basically had to advocate and get partnerships within the university.
So I'd maybe touch briefly on internally, who did we want to check in with first? Definitely, even though this is not a philanthropic fund, we went to advancement. We needed to be sure that the university's advancement didn't see this as a threat and as pulling away donations to the university. They were fully on board and understood that those are different pools of funding for the individuals who are prospects. Also, you want as many people internally taking this as a win for them, right? And so I don't think a fund that's tied to one part of the university is going to have the support as multiple folks across the university see it as themselves as having a role. Externally, yeah, so we, and then later the general partners, when they were brought on board, went around to many of the investment groups and investment venture capital leaders in the community to get their input on structure, on leads, on their support. And I'll say that, you know, we didn't always get the outcome that we thought we had. There were people who were very supportive. There were naysayers. You know, one person that we saw as a pillar in the community said, "Oh, I think you could raise maybe a $2 million fund," and it, you know, $25 million later, it felt pretty good to like kind of, you know, get out in front and surpass those expectations. So, but we had some really great input from folks who have raised many funds on their own, and it's just great to be able to learn from them.
We can't hear you, Kirsten.
So we are over time. Can you guys stay on for another 10 minutes and
Sure.
we can answer some more questions so that it can be on the recording? I know people have to leave, that we have gone over time, if that's okay with all of you. All right, let's get through some more questions then. So next question was, did the universities with venture funds also run a more traditional angel network as well? Bryn, you had that slide up earlier that kind of showed the different pieces of the funding puzzle. And so do you have a traditional angel network? And how did the additional venture capital fund impact that angel investment participation?
So no, we at the time the fund was being raised, there was no angel network. So like quite common for there to be an alumni network, whether it's through alumni ventures or just something that's more organic. We did not have that. That is now coming online in 2025, and they're complementary, right? I think they're separated by stage. And again, looking at that stack, there's room for a lot of different types of investment capital. One thing that I remind folks is that even if you look at the university's proof of concept fund, pre-seed fund, seed and series A fund, and then soon to be an alumni fund, those together I estimate will comprise less than 5% of the total capital raised by our startup portfolio. So it's important local capital, but it's a small drop in the bucket, and they can all coexist very well.
Yeah. Case, is there intention to incentivize investment managers to join the team if all the returns go to the university? You had talked earlier about that was the returns model. How does the management work for you?
The investment managers, meaning like me and
Who's me?
Fred and the
Exactly. Right.
Oh,
Right.
yeah, so that's true. We aren't taking a piece of the company the way someone at the early stage who's actually launching it would normally would. Is there incentive? So Fred and I have been employees here for a while. There hasn't been particular interest for either one of us to to go. I mean, I suppose it could happen. Certainly the EIRs are a different story. So the entrepreneurs in residence, we have gone back and forth on that a little bit, just because they are taking what is essentially an acting CEO role in the beginning. We have not thus far had anybody take an equity stake in the company personally as a bonus or something in addition to the salary while they are employed by the university. We haven't really been able to, you probably could okay that from a conflict standpoint, but we just haven't figured out how exactly, so we haven't tackled it. Because for those companies that the EIR has gotten that interested in, they have actually left to go with. So Dave Licata, I mentioned, who is now an advisor but had taken a previous company out. He eventually took a stake once he actually left the university and became CEO of the company, same with Jay. So it's the timing and the sequence of it have solved that problem. Also because we've had the EIR positions be rotating positions, so it is expected. We want a working EIR, someone who's maybe in between gigs, has maybe exited something and hasn't started something new yet, to land here for a while and have it as a rotating position, ostensibly 2 years. We've kept people longer or shorter if they find something else they want to do. If they leave to do that, that's also fine. Though it is, I will mention that when they are in the position at Caltech, we do expect them to mentor all students, projects, technologies, help all faculty, meaning they aren't here just to go shopping for their next one that they're interested in and focus on that one. So they are expected to be a resource for the Caltech community while they're here, but it's okay if they get interested and want to take it. So, yeah.
Thanks, Case.
Mhm.
As a public university, and this is probably to Bryn as well, then, is there any issue with setting up a venture fund that's investing in companies as a public institution that people need to be aware of?
Sorry, you broke up. Were you directing that to me?
Sorry, I was directing it to you, Mike. Sorry about that.
Okay. Yes, we do have some internal processes that we have to go through. We have to have a tax and legal review, but legally, if there is a conflict of interest between faculty or staff and the startup, and that typically occurs when someone working for the university has 5% or more of the company we're considering to invest in, or has a leadership position, either C-level or board seat, whether that's compensated or not at the time, we must publicly disclose that conflict to the regents of the University of Michigan, who are publicly elected officials. But we can do that prior to making an investment decision. So it's really not a problem for us. And we have a nice protocol standard process in place with our Office of General Counsel reviewing those disclosures. And so typically doesn't cause an issue unless there's a scheduling change in the regents meeting, and we do want to move quickly on investment because we cannot invest until we have that disclosure in place by state law. The rest of the procedures are, I would say, pretty standard, actually. We have a big legal team, so processing legal and tax review of our deals happens within days. So we're fortunate in that respect. But the big issue around being a public university is that disclosure of conflict of interest.
Thanks. Next question is, do any of the funds that you run provide financial support to a project in anticipation? If so, what is the structure and how are returns captured in those cases? Or does that go back to Bryn's slide where there was the different types of funding?
We just had a conversation about that today. And we historically had a translational grant program that did provide returns if any revenues came back from a license, but was supported from this program prior to that. Currently, we don't.
Yeah, it's separate for us. It's separate program. Grants of up to 125,000. Do about 10 to 12 of those a year. That's largely from state money, but also from the university. Certainly, that's a very important criterion that the Buff Gold looks at, right? Have they been successful in getting that capital before they make an investment?
And we also have an internal innovation fund. It's a separate pot of money called the Rothenberg Innovation Initiative that is for projects with commercial potential, but it's in the research side. So those dollars get deployed into the lab, not into the startup. But it was even separate from the seed fund, it was discussed, well, should we try to recover those dollars if the project gets launched into a startup? Yeah, we tried that a couple times. The startup, we were unsuccessful. Even when we tried to make it a policy lowercase p in getting money back from the startup. They're really different entities, and it's very hard to get the lab to commit to somehow agreeing that the startup's gonna give you more equity or something in return. It doesn't even hold up legally. You can't actually get that commitment. So we separated the concepts completely.
So I am gonna stop us there. Questions, and as you all know from your experiences in developing these funds, this is a very complex thing to do, and so I do encourage when we send out the decks, everyone's contact information will be in the decks. Please feel free to follow up with our panelists today to ask them any questions that you may have. Bryn, Mike, and Case, are there any parting thoughts you would like to impart to our people who are either venturing into this or are already in it themselves? Go. Bryn, I'll start with you.
Oh, I highly recommend it. It's super fun. It only takes about 8 years. No, I do think this is a very worthwhile thing that universities can look at. And maybe the final thing I'll just say is that I think these can look so different. I think that at some university, like a $1 million fund might be what you want, and it's just to support your faculty and create a culture of entrepreneurship. Maybe that's what you need, right? So yeah, no one size fits all.
Great, thanks. Case?
I guess I would just say that even I, who tends to not be the optimist on the team, I tend to be the realist on the team, have been surprised at the outsized impact that even small amounts of money, again, back to the signaling thing, even small amounts of money from the university into these startups can amplify by attracting other institutional investors to the deals. And that at the end of the day, that's a great success for us. We're trying to tee these up for, not be competitive with, but tee these up for the A-round investors to get interested. And in that standpoint, only a few small investments is having an outsized impact there. So that's great.
Oh, fantastic. Mike?
Well, I'll say I'm the optimist in our group. And even with that, what we've done at our office with Accelerate Blue and now the University Fund has exceeded my wildest expectations, not just in fundraising, but the success our startups have had, the engagements we've had. So I agree with Bryn. It's worth the 8-year runway to get it off the ground. There's a lot of pain there and challenges, but because not everyone believes in the model. But I think as we see more and more of this activity and the engagement, it's an important tool that tech transfer offices and the commercialization ecosystem around the university should consider leveraging. And there are a gazillion models that there's no right fit for everyone. And then I would encourage what Kirsten has already said. Most of us consider this kind of a mission, and we're happy to help other universities get these things off the ground because essentially we're not competing with each other. We're investing in our own startups. We're engaging our own alumni. And I think there's some great opportunities to explore by engaging with the universities that have been there and done that.
Thank you. And thank you all. We wish you great continued success with these funds, and we look forward to hearing from everyone about their own endeavors in this area. Thanks again for joining us today. Thanks to Bryn, Mike, and Case for sharing their time and expertise, and thank you all for your suggestions and questions, and please do fill out that survey as well. Have a great day, everyone.